morning, ladies and gentlemen, and a very warm welcome to iGEM 2020, this section co-organized by the Malaysia Green Building Council. And welcome to the final day of Financing Climate Action Conference 2020. And for Malaysia Green Building's final slot, we have a very, very prolific speaker lined up for you, who is going to speak on how capital markets can drive sustainability and profit. Ladies and gentlemen, this morning we give you Bradford Doxer, Chief Executive Officer and co-founder of Green Generation. Founded in 2011, GreenGen transforms the world's built environment through its visionary turnkey approach to innovation and solutions by integrating energy, real estate, technology, and capital markets to operate in the green. GreenGen helps its clients use energy as a driver of value across all asset types around the world. Throughout 2 decades of real estate investing, Brad was a principal with McFarlane and Partners, a national real estate investment firm overseeing mid-Atlantic business, and the founding partner of Starwood Capital Europe and Starwood Capital Asia, overseeing operations, direct investments, and operating joint ventures and financing activities. Brad began his career with JMB Realty, then the largest US real estate firm, and later with CRI, then the nation's largest owner of multifamily residential properties, where he oversaw the creation and financing of Capital Apartment Properties REIT, or CAP REIT, a privately held real estate investment trust based in Washington, DC, that focused on market rate apartments in the Eastern US. Brad received an AB cum laude, which is a highest form of qualification in economics, and an MBA, both from Harvard University. Brad serves on the Global Advisory Board of the Urban Land Institute, ULI, Center for Sustainability and Economic Performance, and as the chair of ULI's Redevelopment and Reuse Product Council. He was the founder of ULI Washington's Sustainability Initiative. He is a member of the US Green Building Council and the International Society of Sustainability Professionals, ISSP. Ladies and gentlemen, without further ado, let me present to you the interesting presentation given by Mr. Brad Doxer. Thank you.
BK, good morning, and thank you very much for that introduction. And good morning, everybody. I am actually calling in and speaking to you from Washington, DC, where the choice I had tonight was to speak to you, which is much preferable because the other option is to watch the third and final debate between President Trump and Joe Biden. It's an honor for me to be here. You know, I was telling BK earlier, my first trip to KL was in 1997 when I was running Starwood Capital's business in Asia. And I came at the time because the then Imperial Hotel, which was part of the Starwood Hotels group, had just opened. And I came to see it. And my first inclination, my first impression was it was one of the most beautiful, most magnificent hotels that I'd ever seen in the entire world. And I've had the pleasure of returning to Malaysia a number of times, spending time in Malacca, which I find one of the most interesting places to this day that I've ever spent time. Let me just spend a moment giving you a little bit of background on me and GreenGen. So I founded GreenGen in 2011 with my wife, and we had met out of university working for J&B Realty, then the largest real estate firm in the United States. And the path to founding GreenGen was really after, real estate investment was historically a very simple business where the most of the focus was on top line and revenues. But in 2008, the revenues collapsed with the global financial crisis. And all of a sudden we found ourselves focusing a lot on expenses. And the biggest expense, it turns out, that we didn't know much about was energy, electric, water, gas, and steam. And as we thought about what the real estate community needed, we found that there really wasn't a firm focused on this the way owners and investors wanted. A lot of people were trying to consult, tell you what to do, but neither implement nor execute. And the others wanted to sell you their product. Buy my light, my window, my motor, my software, buy my thing. And we ultimately felt that the right approach was much more of a solutions-based approach, one that was vendor and technology agnostic. We wanted it to be quantitative because people kept telling us the payback was good, but we couldn't figure out where the word good fit in our spreadsheets. And of course, we wanted to include execution to have a seamless approach as we went from a good idea to a good project. And so based on that, and with the experience of asking friends at other real estate firms, in 2011, we founded GreenGen. GreenGen remains based here in Washington, D.C., but we also have offices in London, Tokyo, and Shanghai. And we find ourselves today as one of the leaders, in the world on a global basis, focused on driving energy efficiency solutions. We're different in that, not the part that we understand energy, but we also understand the real estate, the capital markets, and technology. So we're able to articulate a very clear outcome, not only in terms of driving a financial outcome, but also in terms of driving an ESG or sustainability or resiliency outcome, much of which we'll talk about. The majority of our work around the world is for investors. Our large clients include Blackstone, Carlyle, KKR, LaSalle, Schroders in the UK, Allianz Insurance, Nomura. We're very fortunate to have the world's leading investors work with us because we've been able to articulate and drive a lot of value for them. Just to give you a quick bit of background to set up the context of what I'll speak about, we run 5 businesses today. Our flagship business, the one that I'll spend most of my time speaking about, is what we call solutions. And that's where we assess assets and portfolios, we engineer solutions, and then we execute those solutions for the primary outcome of driving a financial return, reducing costs, increasing cash flow, asset value. But we also run an energy data analytics business called Emerald. We have a venture capital business which focuses on investing in technologies that improve the value and operations of buildings. And that's very specific. We're not focused in this business on things that are process related, but rather our primary test is, does the technology impact the income statement of the building, either reducing a cost or increasing revenue? We also are developing projects that have an impact on climate, reducing carbon and creating carbon offsets, which improve the world and the environment. And then finally, real estate investment, where there's a very specific energy opportunity and real estate opportunity at the same time. So let me just very quickly sort of outline what I'm going to talk about. I want to spend a few minutes talking about the climate crisis itself. I then want to talk about a really important question, whether or not profit and sustainability are compatible. For many years, people have felt that you had to make a choice. You had to either drive profit or you had to drive sustainability, but you couldn't do the two at the same time. And that is a conclusion that we fundamentally reject at GreenGen. Then I really want to dig in and focus on the role of capital markets in this. I want to spend a few minutes talking about the role in the research that ULI Center for Sustainability and Economic Performance has been undertaking. The research they've been doing in the recent years has been at the forefront of some of the most important research at the center of profit and sustainability. And then finally, I want to spend a few minutes talking about what it means to operate in the green. This is a tagline that we started from the very beginning of our firm, and it's something that really, as every day goes by, we think is more and more important. So let's just start with the climate crisis itself. The climate crisis is real. The world is protesting, the world is demanding change. And that's true everywhere. This is a picture that comes from KL, relatively recently, and this is typical of the types of protests and the types of demands for change in the climate that have occurred all across the world. This is not a Western issue. This is not an Asian issue. This is not a European issue. This is an issue fundamentally that everyone cares about, because the truth is we only have one planet. There is no alternative to the Earth on which we live. This is a picture. This is something that really impacted me. So 2 years ago, my family traveled to South America, to Patagonia, on both the Chile side and the Argentina side. This specifically is the Upsala Glacier in Argentina, near Lago Argentina or Lake Argentina. And what you see on the top is the glacier, the Upsala Glacier in 1978. 30 years later, only 30 years later, this glacier had moved over 200 meters. And it was remarkable because one of the things we found when we went there is we saw a hut. And as we talked to the people that oversee the glacier and are the stewards of the glacier, we asked about this hut. And what they said is this was a hut that 30, 40 years ago, the Argentina Ice Commission basically used. They were doing various tests. This hut was now 200 meters away from the glacier. 30 years ago, it was very much in the middle of the glacier, and it was really quite shocking. We hear about this, but to actually see it was, remarkable from my point of view. This is somebody I think that we all have come to know very well. And one of the interesting things about the climate crisis is, in many respects, people my age, people's beak age, we weren't able to get through to the millions and billions of people on Earth. It was the next generation. It was the teens. It was Greta who finally got the world to pay attention and brought everyone, including elected leaders around the world, to really focus on this issue. As we think about the Paris Accord and the COP21, this is a chart that shows the obligations and the goals of the United States. What you see very clearly is the goals from Copenhagen, the COP, and the COP21 in Paris, the agreement target, are going in one direction. The US CO2 emissions are going the other direction. This is not good. And while I recognize that the United States under President Trump moved away and basically walked away from its obligations under the Paris Accord, which will technically happen in a couple of weeks right after the US election, we also recognize that there's another candidate that will put us back in the COP21 Paris Accord and put us in with the rest of the world in terms of reducing our CO2 emissions and adding a very aggressive target. And then finally, this is a chart, a graph that shows what would happen with a 2.5 meter sea rise. This is a level of sea rise that many scientists think is possible if we do not make a change. This represents what happens and what Manhattan looks like. And you can start to realize that only 2.5 meters will push in tremendously on lower Manhattan. And if we don't do something, if we don't think about this issue, frankly, yesterday, we're in real trouble. And then finally, the reason I think this is so easy to solve in some respects is that while climate risk is very real, climate risk also represents a tremendous investment opportunity. It was only this year in January that Larry Fink, the CEO of BlackRock, the world's largest asset manager, made it very clear that sustainability and climate integrated portfolios simply have a better risk-adjusted return, and made it very clear that climate was something that BlackRock in all its activities was going to take in consideration. And then a week later, Steve Schwarzman, the founder and CEO of Blackstone at Davos, gave an interview to the Wall Street Journal where he fundamentally said very clearly, sustainability ends up being good economics. It's not about doing right for the climate. Of course, that's important, but he recognized that sustainability and investing in sustainability, that's just where the profits are. That's how you make money. And now with COVID, in the new world we live in, health and safety likewise represent a tremendous investment opportunity. We sit here today talking about air quality, better buildings, and cleaning. And the reality is that buildings that can demonstrate that they're addressing COVID, that they're addressing better air quality, that they're addressing the health and safety of the occupants and other stakeholders, are going to be the buildings that people want to occupy. They'll be the buildings that people want to rent. They'll be the buildings that generate profit for their owners. And we don't have to agree on how climate change has happened. I think most of us, if we're on this call and we're involved in various parts of the World Green Building Council, whether it's in the US, Europe, or Malaysia, we will all agree that the science is clear. But honestly, we don't have to agree. The only thing we have to agree on is that there's no negative value associated with reducing carbon and greenhouse gases. And if there's no negative value, then the things that we do to improve our assets simply are good business. So what do we do? And the real question is, are profit and sustainability compatible? And I'll give you a little sort of insight, and I'll sort of take you to the end. The answer, in my opinion, is absolutely yes. In the US, the Western view, espoused by Milton Friedman, who was an economist that came out of the fairly conservative and rigid milieu of the University of Chicago in the 70s, basically took the view, and this was a view that CEOs of Western corporations took for decades, that the only responsibility a corporation had was to increase profits for its shareholders. They had a very narrow view of stakeholders. It was the people who own the equity in the business. The focus is on investing to drive the profits of that business. It was to no regard for employees, customers, communities, planet, climate, anything, profits. But today, what you've seen in the last 12 months is the Business Roundtable, a group of over 100 leading CEOs from around the world, have changed that. They have basically said Milton Friedman was wrong. The view today is focused on investing in workers and communities in our business so that we create an economy that serves everybody. And when you think about serving everybody, when you think about all the stakeholders, not just the investors, the employees, the customers, whether you're an industrial company selling a aerospace part to someone who makes jet engines, or somebody who makes detergent and soap for consumers, millions of consumers that are buying it at different stores, those people matter. The people who work for your company matter. If you don't have a company that people want to work for that doesn't show regard for its community, people don't want to work there. They won't buy your product, and companies won't have a place to go. The communities, the countries will not want them to be present. This is a new view. This is the view increasingly that companies are taking, and it is a view that leads to a co-benefit of both profit and sustainability. Let's talk for a moment about green bonds and green finance. This is probably the fastest growing aspect of the capital markets in the entire world. Mutual funds, insurers, pension funds, sovereign wealth funds, all are saying, we think the environment is important. We want to see bonds and fixed income products align with this view. And green bonds fundamentally direct funds to environmental and climate projects to encourage sustainable growth, essentially saying it's not just about profits, but it's this larger view of how do we invest for profits, but also in a way that reduces our carbon emissions, our greenhouse gases, that uses less water, that uses and creates less waste and is better for the planet. This is really something that's become super important to people. And the capital markets, basically they do three things. They allocate capital to projects to create growth. Their business is designed to give money so people can invest in their business, they can build buildings, they can build factories to have an economic impact. But in doing so, they also assign a cost of capital that, in their opinion, represents the risk of the investment and other externalities. And for decades, the argument has been made that they really mispriced the externalities. They didn't think about the impact on waste, on carbon, on greenhouse gases. People were happy to give a low cost of capital to building a power plant without regard to the fact that it was spewing fossil fuels and creating carbon in the air, making it unhealthy and making it lowering real estate values for people to live, creating asthma and pulmonary issues for people, increasing the cost of their healthcare and reducing their life expectancy. But that has changed. And now the so-called misunderstood climate externalities are now being much more priced into the capital markets. And hence you're seeing a much larger interest in green bonds that align with what people are looking for. So in a holistic system, profit, in my opinion, can only occur when it's sustainable. You can't build a power plant. It's the easiest sort of thing to think about. You can't build a plant that's using coal because it reduces the real estate values. Nobody wants to live near a coal plant. People don't want their kids to be outside. They don't want the air is bad, the real estate values are bad. And so the holistic system is basically saying profit occurs when you're thinking about all these different environmental factors. And this matters because companies that operate around the world, for them to really be profitable, they need to get capital to want to invest in them, to align with them. They need to get people to want to work for them. They need to have people that want to buy their product. And they need to have communities that want them to locate with them. And if they don't have any one of those things, they don't have a business. They can't grow their business. They can't have a sustainable business if people won't work for them, buy their product, or communities won't let them go there. And this is really the fundamental nature of what sustainable finance has become. This is really indicative of how fast this is growing. So you look at what's going on today. This is an article that's only about 4 or 5 weeks old, and it talks about, the green bond market is going to reach $1 trillion in 2021. You look at what's going on in Europe. Europe's recovery from COVID is nearly 2 trillion euros of economic activity focused specifically on creating a more sustainable economy. This shows what's happened with the growth of green bonds. The green bond market has grown from a relatively small part of the capital markets in 2015 to a tremendous number of over 250 billion US in last year alone. And the green bonds finance all kinds of things. They finance energy efficiency, they finance pollution, sustainable agriculture, but also things like fisheries, forestries, aquatic ecosystems, and the things that often many of us care about in a smart city or built environment, transportation, electric vehicles, clean water, and of course, sustainable water management. These are issues that are really at the forefront of economic development today because, if you don't have clean water, you can't have a city. If you don't have good transportation, you can't have a city. These are all things that have become increasingly important. This is actually a building that probably everybody that's listening knows more about than I do. But this is an example of a building in KL under development now, one of the world's leading and tallest buildings. And how was it financed? It was financed in part with the Green Sukuk framework, which is a green based on green bond principles. The 2 billion ringgit financing had a lot of really great environmental and sustainability aspects, multiple green certifications, lots of social benefits were integrated into the design. But what's important is that this financing gave the developer improved access to capital markets. The people and the firms and institutions that want to invest in green bonds is frankly a faster growing part of the capital markets than any other part. And because they want to be involved in this, because they want to finance projects like this, you end up with a lower cost of capital. So this is about higher proceeds, more money, lower cost of capital, and ultimately better projects, because these are projects that have a certain degree of regulation and guidelines and oversight that lead to an improved commitment to the environment, as well as reductions in energy, CO2, water, and waste, lower environmental footprint. And because they're sustainable, they end up being simply better investments. They're more desirous to tenants. They lease up faster. The cost to carry them, in other words, the cost to finance the cost of building it before you get the tenants is lower, because people come into the buildings faster than they would a regular building. Here's another example that we worked on a number of years ago. And this is a project that was financed by the Inter-American Development Bank, which is the sister organization to the Asian Development Bank based in Manila. We worked with the city of Montevideo, Uruguay, to focus on both using technology, but also data to reduce their electricity demand during peak periods. Their peak period is between 6 and 10 every day, Monday through Friday. The peaker plant is in downtown Montevideo. It is in the middle of the city. It is diesel. And when it is running, not only is it expensive because it's diesel, but the air is very bad because you have the smell and the stench of diesel across the city, meaning health outcomes are worse, asthma is higher, lung and pulmonary issues are higher because the fine particulate matter is much worse. And it also impacted real estate values. So the value of the real estate close to the peaker plant for the utility there called UTE was lower than it would be with the peaker plant out. And so we put in motion a plan to help people become more aware of the energy they were consuming so that they could use less energy during peak periods and ultimately move the peaker out of downtown Montevideo. So let's turn now to a couple of pieces of research that the Urban Land Institute, or ULI, has done in recent years. This is a number of reports that have come out recently. I'm going to talk about 3 of them, but I also want to highlight one in particular, which is in the bottom right-hand corner, the Climate Risk in Real Estate report that came out 1.5 years ago with ULI and Heitman. This report highlighted the importance of resiliency and the impact of climate. And I participated in the launch of this in Hong Kong, where this report highlighted the exposure to up to 65 million people in the Pearl River Delta. So when you have flooding and typhoons that go up from Hong Kong up to Shenzhen and Guangzhou, more than 60 million people are at risk because of this. And with that, all the real estate that they've got. And I just want to highlight for a moment before we talk about the research, these are all the groups that have agreed to a net zero goal. This list came out not more than 2 weeks ago. And in particular, there's one company, City Development, or CDL, not too far away from KL down in Singapore, that has committed to the net zero goal. And their head of sustainability, Esther An, is one of the great leaders in the world, but it's certainly in Asia, on helping articulate and think about the profitability of sustainability. So let's focus on 3 reports, because the reality is capital is not the issue, in my opinion. It's the lack of vision. It's the inability to know exactly what to do. And the real question, I think, for many of us who are working inside organizations with people who are perhaps skeptical of sustainability, is how do you sell it? How do you get people to do something that is not only good for sustainability, but also drives the value of the organization? So the seminal report that you and I did a year and a half ago was one that I was involved in. And it's entitled Embedding Sustainability in Real Estate Transactions. The idea here is not to make sustainability a separate thing, a standalone thing, but essentially to get sustainability to become part of the basic real estate cycle, to have it involved when you're buying the building or when you're designing it, when you're financing it, when you're holding it during the whole period, the operations period, and then even before you go to sell it. And the study identified 11 different stages of value creation. Let's talk about just 3 of them. So the first, this is a report, it's a report that we did for a building in North America about 2 weeks ago. So this is, August 2020, a brand new report. And it was one done in conjunction with one of our clients when they were buying a building. The idea here was to essentially identify the energy plan right at the beginning. What should you be doing? How do you invest in the building in a manner that both drives the cost down, the cash flow up, the asset value up, but also empirically, you have to be improving the sustainability metrics, the KPIs of the asset if you do that. There's no way that you can't do that. If you use less and drive the value by using less, you are using less energy, it's reducing the greenhouse gases and carbon, you're using less water, meaning the strain on the water system and the city system is lower. And this is something we find ourselves doing more and more, where people want to get this plan into the asset right from the beginning. So it's in the business plan at closing, when you buy it. We also are doing more and more on the design side. And that's essentially people saying, listen, when we're building it, we want to make sure that we're making the right choices, because there's often a tension between life cycle and first cost. And when you go to value engineer out certain systems, it often ends up being that you'll save perhaps $1 million ringgit, but you've also now increased your operating costs by 150 or 200,000 ringgit. Leaving lease structure aside, if you put a cap rate or a multiple on those savings, you're essentially saying we're saving $1 million, but we're destroying 2 or 3 of equity value. We've done this enough to know that sometimes that $1 million ringgit isn't available. You have to shut it. You have to find a way to cut it. But it's important that everyone understand that every design decision is also a financial decision, and these are not separable. This is a building that's actually in the US. It was a building that we got involved with during the hold period. It was already owned. But the important thing to understand here is that we developed a solution that cost approximately 300,000 US. The local utility rebates covered about 1/3 of that, just over 109,000, leaving a net cost of about 200,000, which we actually financed not from the owner, but we actually got from the reserves that were in the mortgage. This had an existing mortgage. There were capital reserves to maintain the value of the asset. We worked with the lender for them to understand that if they release this, work would get done, that actually the asset ended up having a better cash flow and higher value. And so using 200,000 of reserves, we essentially had $100,000 of annual savings at a 6 cap, approximately a 16.7% multiple. We created nearly 1.7 million US of equity value. Tremendous project, but at the same time, this now is an asset that performed better. It was cooler, it used less water, less energy. The thermal load from the building envelope was better. We added software on top of the controls for it to operate better. This was simply an asset that was worth more, that performed better, not only for the owner, but for the occupants. It was more comfortable. Productivity was higher. A real win-win, if you will. And then finally, this is a building in Asia that we worked on 2 years ago. And we are brought in prior to the sale to identify projects and work that could be done by the buyer of the building. The idea here was to articulate where savings would come from. This building happens to be in Japan, which trades at the highest valuations in the region. So the annual savings, and this is all in dollars instead of yen, the just over $1 million US of savings at a 3 cap translates to over 30 million of equity at a cost of 6. So it generated a net increase of 24 million US, which is a very significant amount. And it became one of the more compelling aspects of the sale for potential buyers. So they were making more money, but they also had a really important sustainability impact in a country that is increasingly focused on reducing its carbon footprint, its water footprint, and its overall environmental footprint. And the reality is, climate is a major challenge, but the key is, how do we turn it into profit? These are headlines from the Wall Street Journal, Washington Post, and New York Times. And I apologize because this certainly is slightly Western centric. But these are all headlines from January 17th of last year. Front page headlines: climate change alarms businesses, are alarming client. Climate change isn't the great crisis. This was a time where everything on the front page of every paper was about climate change. I'm actually pleased to say, so I was out of town all last week, and I came back and I went through all my newspapers in the last 2 days. One of the best things, I suppose, from a climate point of view, maybe not from a political point of view, is that there were almost no articles in the last 10 days on climate. Everything was about politics. Everything was about the elections in the US. Climate has been pushed off, but that's going to change and be returning again very quickly. So let me walk you through the simple math on sustainability. Let's say we do a 5-year payback. We invest $5 to get $1, so it pays back in 5. That dollar, leaving lease structure aside, if it drops 100% to the bottom line at a 6 cap, and a 6 cap is essentially a 16 multiple, that dollar becomes $16 of equity. It cost 5. So this is a project where you invest 5, you get 16. In our world, there aren't many places where you can invest $1 and in less than a year get $3 back. That's the financial side, that's the fiscal side. But you've also, in doing that, reduced the greenhouse gases and carbon. The hotel report that you and I did last year also talks about not just driving the bottom line and the value of the asset, but you've also enhanced the guest experience because it operates better. The controls are better, thermal load on the building envelope is better. That then gives you better access to groups and meetings, because groups and meetings care tremendously about sustainability today. When you're looking for a location, you're giving a questionnaire to a hotel and you're asking, what are you doing about the environment? What are you doing about climate? How do you think about your people? If you don't have good answers to that, you will not get this business today. This also ends up enhancing the reputation, not only of the hotel itself, but the brand. So, this wouldn't just be good for, say, a hotel if it was a Westin or a Shangri-La. The hotel would benefit, but also the brand, would benefit from improved sustainability. And then finally, the management company itself, its reputation, its value. We're working with a global hotel company right now that is looking to invest in its hotels with its operators and franchisees, both because it will help them financially, but because they know it will improve the reputation of their brand. The final report I want to talk about is a report that just came out 2 weeks ago. This is a report focused on the business case for resilience. It focused on Southeast Florida, the Miami region, which, as many of you will know, floods on almost a daily basis. When you have a combination of high tides and full moons, you have significant amounts of flooding in Miami and South Florida, because it essentially is sitting at sea level. But this report also articulated and identified 2 really important numbers. One, the return on investing in resiliency itself. When you invest in resiliency, you get at the community level a return of over $2. Every dollar is actually $2.08. But at the building level, this return is essentially double. Every dollar you invest, you create $4 of value at the asset level. And why is that? Because investing in resiliency, which is important unto itself, has a couple of really strong economic things and community things. It reduces the risk of flood-related threats. So if you start to put in berms, you start to put in landscaping that will collect water, instead of it letting it come inland, it will collect. It will reduce the risk of floods. Now, why is that significant? Because that will help you avoid the loss of real estate, tourism, and sales tax. If you've got, for instance, in South Florida, in South Beach, you had significant flooding from a storm a couple years ago. When that happened, the hotels are closed. There's no sales tax, right? There's no people coming in. There's no food. People aren't working, so there's no payroll taxes. There's no income for them. Real estate values drop. One of the things that we're expecting across North America and Europe and Asia is that because of COVID, a lot of owners are going to start going to their governments in the next few months saying that next year's taxes, they can't pay the taxes that they've been paying in the past because their economics have been harmed. And we expect a lot of governments, a lot of elected officials to simply say, we'll waive or we'll give you a discount on your taxes. But it also means that the property damage increases. Jobs are not created. Quality of life is impacted. And in many places, the low-lying areas are areas where often low-income communities live. So the wealthier tend to live higher up in communities or up on the hill, and the poor citizens of a city will live in the lower areas. That means that when there's flooding, typically it hits low-income communities faster than wealthier communities. And finally, there's also a tremendous amount of budget volatility. Owners of buildings and governments are funny. They're always unwilling or really hesitant to reserve monies for flooding and resiliency. But when an event happens, they have no choice but to clean up the street. If you're flooded, you have to repair your building, you have to repair the street, you have to put the infrastructure back in. You have no choice but to do it. You had no discussion about it from a budgetary point of view. What to do, how to do it, what to pay. You couldn't bid it out. It just happens. And so investing in resiliency means that the likelihood of these types of events is going to be much lower than it would be when you don't invest in resiliency. And so just to sort of start to wrap up, the real question you have to ask is, why would you invest in ESG or resilience in the first place? And it's a fair question because historically people haven't been able to articulate what the profitability of, what's the financial reasons to do it. But I think it's becoming clearer and clearer to people around the world. Resiliency and sustainability drives cash flows. When you drive cash flows, you drive the asset values. If you're an owner, if you're a developer, higher cash flows, higher asset values means that higher fees, higher promotes, higher profit. But that's not all, because now at the community level, the other stakeholders are also seeing reduced environmental metrics, lower greenhouse gases. They're seeing, less consumption means lower energy costs, lower peakers, means you can have a higher share for renewables, meaning carbon is simply lower. And when you do this right and you do it properly, you're also creating tremendous amount of net jobs. And so one of the keys here is that throughout the process, all of us, whether we're the developer or we're advising the developer, we're building the building, we're designing the building, we have to make sure that we're asking good questions at every stage of the real estate cycle. We have to question everything along the way. Why did you spec this particular window? Why this light? Why this mechanical system? Why these materials? Why are you building it this way? Why in this location? Why not renewables? Why do we have so much parking? We have to think about the risks of doing it wrong, but we also have to recognize that if we do it right, the rewards, both financial and non-financial, are very significant. And perhaps the most important thing is that we have to recognize that the way we've done things in the past isn't going to succeed in the future. We have to commit to change. We have to commit to thinking about, frankly, a broader view of winners and losers. It's not just about the tenants in a building, but now it's the tenants, their employees, their guests, the people that shop at the restaurant, the people that buy the products, the people that work at the stores, the community that's located next to it. So if things are done poorly, the neighbors will be impacted. And of course, just the overall community in which we're sitting in. We have to think about these things, and we have to commit to the idea that we are only one part of a much larger system. So finally, I said, at the beginning, when we started GreenGen, we had a tagline called "Operate in the Green," and it seemed very clever in the time because buildings that are profitable, they operate in the black. Buildings that lose money, they operate in the green. And we felt that if you do it right, if you think about both profit and sustainability, you're operating in the green. And the green is both a financial one, meaning dollars and ringgits and euros, but it's also about the environment. And when we do that, we really think about a couple of things which we think are just fundamental to this approach. It's a broad view of stakeholders, not just the person who owns a building, the person who leases it, but as I said before, their tenants, their guests, the community, a much broader view of what return is, not just financial, but now the impact on the community. Are we using less energy? Are we using the right kind of energy? Are we using less water? Are we using lots of water for landscaping? We're using gray water for the building system. How can we reduce our impact and footprint environmentally, but also still a building that works for our people? It's an enhanced thinking about value creation and what does value mean. But as I said before, in the example of in KL, green buildings also have better access to capital, meaning they get access to more capital and the cost of that capital is lower. The fastest growing part of fixed income debt markets in the world today are green bonds. And it's because companies have recognized, on the one hand, there's people who want to own them, they want to invest in them. On the other hand, they've got projects that fit very well into this double bottom line of profit and planet. And it's really about not just investing in buildings, but investing in people, the assets, and the technology themselves. And then finally, I just want to sort of make a point that while we talk a lot about sort of operating buildings and designing buildings, there's also an aspect that involves investing in technology, because innovation is very important. And it's important that we keep in mind that the ways that we do things today, there may be a better way to do it tomorrow. And these are 4 companies that we've invested in the last year. And our approach to investing in technology is really focused on things that impact the value of the building. And each of these sensewares focus on the Internet of Things. It is a Muslim woman actually who grew up in Saudi, came to the US to do her PhD, and then we invested in her business last year to help her grow it. DataQuip is focused on cloud-based commissioning. Wind is focused on air quality, something that we didn't think much about a few years ago. But the more we've worked in Asia, the more we've seen COVID, the more we've come to understand that the importance of air quality. And then Conservation Labs is finally a company that we invested in only 2 weeks ago that's focused on water leaks. Not a very sexy business, not a really exciting business, but in the US, it's a 70 billion US issue at the insurance company level, 70 billion a year in insurance claims. And this is a company that's using acoustic sensors to identify leaks and using machine learning to basically listen to pipes and listen for leaks before a person could hear them and see them, to cut off the building with the goal of mitigating the leaks quicker and reducing the cost of those leaks. So with that, BK, I want to thank you so much for the opportunity to talk to you and everybody today. And I'm happy if there's a few questions to take a few minutes to answer any questions people might have.
Thank you very much, Brad. Actually, the pleasure is entirely ours. Your talk was so very informative, and more importantly, it was so very relevant to this part of the world. And I could actually see opportunities unfolding before my very eyes as I was listening to your words. Thank you very much for that. We really,
thank you.
Malaysian Green Building Council appreciates this. Thank you. So Brad showed us that from our old beliefs that green was more expensive, slowly, very, very slowly in Malaysia, we transformed to say, maybe it's the same cost, but then there's no benefit in doing it. To very, very clearly, empirically, and through case studies as well, how embracing sustainability at design phase and then careful and accurate implementation of it can actually benefit us on many, many fronts, tangible as well as non-tangible. You know, Brad, as you were speaking, I was thinking that as within a city which has got a very dense buildup of tall buildings, as you start to transform one building and then the next, the other buildings and the community around it gets influenced. And this is very much like what happens in nature. When one tree starts growing, the supporting plants around there, whether they are shrubs or grass or what, benefits from its shade and from the fruits that fall and rot into the ground. So this kind of symbiotic growth seems very true once we start efforts like what you do within a densely cluster of buildings. What do you think?
No, I would agree. And I just want to stay on that for a second because, you know, in Colorado, for instance, the aspen tree, which grows very densely, is in fact one single organism. It's all connected sort of below the earth, you know, similar to sort of how sometimes mushrooms are. You know, in the US, I think they say the largest mushroom is like 70 or 80 acres because it's literally one organism. So when you do something that's good for one, you know, it may not be direct at the moment, but they're all connected and the health of the entire system is connected. I mean, listen, you know, I have a fundamental view, and I'll step away from the building sector for a second, that, you know, one can't be better off personally if their community is not better off. You can't say, well, I'm really doing great here, but, you know, my neighbors and my, you know, there's fire and flooding and everything around me. And is it really resilient? Can you really say I'm resilient if I'm on a hill, but the flood comes up and so all of a sudden I'm cut off from everywhere else? And so, you know, it's interesting because I would say initially what happens is that people invest in buildings and it's a sort of what I'll call an offensive thing. They do it, they create premium for themselves. They get higher rents, they get higher occupancy, they have a more attractive building. Over time, as more and more do it and try to catch up to capture those excessive premiums in value, what ends up happening then is slowly it starts to become a defensive thing. If I don't do this, I start to fall behind. Now, I think we saw that, for instance, with LEED certification and perhaps BREEAM, where initially in cities, people would say, you know, I've got a LEED certification, I've got a BREEAM in use, and it made their assets more attractive. As more and more buildings do it, and sort of it tips from a few buildings to a lot, all of a sudden now, if you don't, you're not getting, by doing it, you don't get more value, but if you don't do it, you become a Class B building. And it is certainly, I think the important thing, you know, in your question, BK, is the catalytic effect of the first projects. And so the first few projects have a really strong catalytic effect on communities. I remember a number of years ago taking the mayor of New Orleans, Mitch Landrieu, before he became mayor, into Washington, and we're looking at some projects that have been catalytic, including a project called Gallery Place in the Verizon Center, where the basketball and hockey teams play, because the owner built that and it really anchored the area. And we talked about, it can be real estate, but in a New Orleans context, it could also be an industry. And so if you built a building that had music studios and anchored from an entertainment point of view and brought people in, that also can do it. In a KL context, you could have a facility or an area which had artists, that had artisans, that had people making things and manufacturing, and that in itself would drive more people. Then you've got people who want to sell it, people who want to ship it, people who want to do magazines about it, people who want to take pictures of it. The catalysts don't have to be financial, but they have to be authentic. They have to be parts of the economy that resonate with people, that have a certain corpus, a certain sort of depth that naturally occurs in the community, in order to really have the effect that I think many of us want when we're thinking about communities, not at the building level, but really at this community or city level.
That's just fantastic. Thank you very much for that. Brad, you showed a copy of the business case for resilience. I think that was produced by ULI. Would the contents have any relevance to Southeast Asia or these parts of the world? And how can we get access to a copy of it?
So there's two different questions there. The report actually is literally not even published. And so I have, because I'm on the board, I have an advanced copy. I will check tomorrow and see if that's something that ULI will release. They did a soft release 10 days ago. And I'll check with them and I will let you know. And if it's something that I can share, I have a copy, so I can easily send it to you for distribution to people who are interested.
Sure. Thank you very much for that.
And I'll have an answer for you tomorrow. But I think the answer is, and the reason why the report's important is it is relevant to every community. The numbers may change. It may be that in an ASEAN context, investing, 1 ringgit may get you not 2.08, but maybe get you more or less. But the fundamentals are the same, is that when you make an investment in one aspect, there are multiple returns. And it's not just the return, in terms of flooding, but asset value, sales tax, job creation. And I think that's the important thing that, that the report, we wanted to take away for the report, is that return is a really complex, multi-factor thing. It's not a single aspect. It's not one thing. It's a lot of different things. And it's typically, and typically by being a lot of things, it ends up being much greater than you realize when you first start to think about it.
Sure. Thanks a lot for that, Brett. We've got a couple of questions, but in the interest of time, let me try and go through them as fast as we can. So the first question says, at the current rate of transition to clean energy, will we meet our climate targets? Not so much of a question for you, really not mainstream, but then it goes on to ask, and if not, in your opinion, do you think that finance can accelerate this? And if so, how?
Well, this is an interesting question. So I fundamentally set this up as, this is the question of, this is the tension between what I'll call Bill Gates, who believes that we don't have the right technologies. We need new technologies. And at least in the US, someone like Jigar Shah, who was the founder of Sun Edison, he didn't invent solar panels. He basically created a financing vehicle to make it easy for people to put solar on their roof. And he lives just up the street from me. And this is the tension. Is it the technology or is it the business model? And I have people come to me all the time saying, we just don't have enough capital to address climate. It's like, no, there's unlimited capital. The problem is we have to turn ideas into projects. Capital markets finance projects. Most people have ideas. And, do I think we need more technology? Sure. Do we need to wait for new technology? No. Do we have plenty of technology today? And I would argue that, more than anything else, it is a business model issue of how to deploy and how to catalyze capital. Now, I will say, we know what to do. We have the ability to reduce climate, reduce energy, reduce the temperature in order to get back on track. The real question is, do we have the will to do it? And the problem is that, candidly, the people running the world, I'll make this very macro, the people running the world today are not the people who are going to be here in 40 years. I mean, we have a US election right now between two people that, from an actuarial point of view, from a statistical point of view, will not be alive in 10 years. The likelihood, of Trump, being 85 and Biden being 87, 50-50 at best. They're making the decisions for people, who are in their teens, that, or in their 20s. They're going to be around for an awfully long time, who, if we don't do this right, they're the ones that bear the brunt of the impact. So, we know what to do. The question is whether we're prepared to do it.
Right. Thank you very much for that. The most inspiring 3 words you said there was ideas into project. Fantastic. Thank you very much for that. It rang a chord in me, and I will remember this for a very long time. Hope the audience benefits from those 3 words too. Ideas into projects. Moving on to our next question, Brad. Into the future, how do you view the role of carbon finance and carbon credit schemes to instigate increased abatement of carbon? Now, we know that we had one round of a failed effort in the carbon credit scheme. Yeah. So what would be your response to carbon finance and carbon credits in particular to instigate the abatement in the building context?
It's a really important issue. We've got people who are, this is the only thing they do. I would look at the number of companies that are making voluntary commitments today. And, there are over 1,000 major corporations from around the world who have, without, having to do it, they basically said, we're going to be carbon neutral by 2050, by 2060. They're all doing it. The truth is, very few of them know what they're going to do to actually achieve that. So there's still a gap between commitment and action. And I think the way you're going to get there is by, thinking about a price on carbon, developing projects. We're actually working on sort of 2 initiatives right now. One is the ability to create carbon offsets and VCUs from permanent reductions of energy in the built environment. It's complicated because the scale is really hard. You can basically, not cut down 50,000 acres, or you can sort of do one building at a time, and one is much easier to do. But we're also looking at, where are the climate impacts now? Where are greenhouse gases coming from? Where's carbon coming from? Where's methane coming from? And we're thinking about the ability to develop projects that mitigate those emissions today. And that's something that can be done around the world. And typically, these are projects that are in all of our communities. They're very close. Most major cities around the world in some form have an oil well, and Los Angeles has thousands of them. Literally, if you go from LAX airport up to UCLA, in Culver City, you're passing hundreds of oil wells right, today in the city.
Amazing. Thank you very much for that. A couple of years ago, I heard the Tokyo metropolitan government having a carbon abatement scheme amongst buildings. And that was very interesting, but I'm not sure how it went or what it's doing right now. One building abates carbon and records it. And then the next building has to have some initiative to abate their carbon. But can buy carbon credits from this building to top up and to get to a certain stage, which was really interesting. If you can move to the next question, which is clubbed to actually the next question and a question after that, I will ask it together because they are related. With the advancement, the first one says, with the advancement of climate change, urban farming is becoming more and more relevant. How do you think real estate will synergize with farming to carve a niche within cities And clubbed to this question is one that says vertical farming and urban farming. Probably he means, is it applicable for green bond initiative or for raising green bonds if we are doing vertical farming within a city or a building? Thanks.
I'll take them in reverse order. My understanding is that vertical farming agriculture is very much aligned with green bond principles, and so it is very much eligible. And the real question is, what's the role of urban farming? And farming, ultimately, it's a balance between efficiency. That's why we've seen sort of historically more and more industrialization of farming, because just the economies of scale become much more important. But that's typically moved farming further and further away from metropolitan areas. And so now, as we start to think about more of a systems-based approach, so it's not just the cost of producing, say, a head of lettuce or a carrot, but now the transportation costs associated with bringing that, the congestion, the carbon, it becomes interesting. Not every city is well developed for urban agriculture. And part of it becomes a question of, do you have existing real estate stock? I think the successful places have been where urban farming is going into repurposed buildings, adaptive reuse of older warehouses that have the load to take it on, but also where electricity is low and water is plentiful. Crops need water. One of the problems that we have in the Central Valley, California, which is where a tremendous amount of our crops come from, is that there's a water shortage. Almonds, for instance, all come from the Central Coast in California. Almonds are the worst agricultural product for water. The amount of water you need relative for one almond versus other crops is horrendous. The environment would benefit tremendously if we got rid of almonds. Now, we're not going to, because I eat almonds, we like almonds, but almonds are terrible for the environment because of the amount of water that they use. And so I think, it's thinking more and more about, the amount of water, the amount of energy that goes into it, and where exactly should we be doing it. And I think the other question with urban farming is whether or not there's a role for urban farming as part of mixed use projects. So repurposing shopping centers that they have, they have a lot of columns, they have high, ceiling height. Should that be part of, the repurpose? And they have no windows, so they have really big depth. Is that, for instance, an interesting use of the center of shopping centers that don't have access to windows or, the outside?
Thank you. Brad, one of the challenges I have seen, and a few of my colleagues have seen, is to the minimum size, and yes, you did hear me right, the minimum size of the amount we can raise. Typically, urban farms would not require as much money as the building itself, especially if it's a repurposed building, which will bring us to the next question. But the thing here is that, could you give us an idea of what, if we want to raise a green bond for an urban farm, what would be the minimum size we're talking about? Just a ballpark figure.
Yeah, what we find right now, green bonds are simply sort of a type of corporate bond. So, it's not a separate market. It's the same people, but it's classifying the use of the bond as differently. So, we still find, in most cases, anything less than 50 million US, so it's a big number, there's very limited demand, partly because the capital markets have recognized that it takes the same amount of work to raise a $50 million bond as it does a $1 billion bond. And they prefer to do a $1 billion bond because they simply make more money from the same amount of time. So it's really not, in its traditional way, it's not a great tool for small projects. Now, there are banks, there are lenders, there are organizations that are raising large amounts, and they're going to the capital markets to raise green finance. But then their business model is to do it in smaller chunks. This is the theory behind microloans, for instance, in Indonesia or India or Bangladesh. where organizations are raising 50 million, but they're putting it out in much smaller chunks, and that's their business model.
Great. So we take the next question a little bit away from this topic. And the question says, with the pandemic, a wave of repurposed buildings or the need for them has emerged. What are your views on the opportunities that may be presented due to this, and what are they?
I think the opportunities are pretty significant. So we put out a white paper in June called The Fundamentals of Trust. And the idea generally is that in this COVID environment, we're not the same people we were. So the person that, in February, March is not the same person today. Our spaces can't be the same either. But we've spent so much time trying to take technology and integrate it into the built environment so we don't see it. Better air quality, better air handlers. We don't know what better air quality means. We don't see it. The filters are hidden. And so the challenge now is, how do you convince somebody that you put in better filtration? And so, one of the things we're doing is we've taken air filters and we put smaller air filters in our space in a way that people can see them. We put monitors so people can look at temperature, CO2, humidity, light levels, VOCs, fine particulate matter, 1.0, 2.5, 5.0, and 10. But we also recognize people generally don't know what the numbers mean. So we've also added sort of a data visualization, simply saying it's green if it's inside the good range. And those are the sorts of things that we're doing. People are funny. We get information in 5 different ways. We hear it, we see it, we smell it, we taste it, we touch it. And so we think of it really a multi-sensory approach, and there are going to be some buildings and owners and developers that do it really well, and they get people to trust them and be confident. They will come back into their building, they will leave space in their building, and there'll be others who don't do it very well, and they're going to see tenants leave.
Fantastic. What a wonderful viewpoint of how to translate how we sense information into delivering it so that it gets completely understood by the viewer. So on to our final question, and it looks like we are perfectly on time, Brad. The final question is, well, let me read it out. In what order of priority would you place this generation events, such as these below, or any more that you may want to add? A, net zero buildings, B, health and well-being, C, pandemic-ready buildings, and D, green building certifications. Just if you could give us some sort of approach strategy in terms of priority currently. Thank you.
Yeah, I think, well, these are all sort of 4 different things. I think part of it is that they're all complementary. I think generally speaking, health and safety is going to be highly correlated to the notion of what's a pandemic-ready building. A pandemic-ready building is going to be a building that not only thinks about how it operates financially, but how it operates and impacts the stakeholders, the health of the people, the air quality. I think the green building certification is that's just a sort of a way to recognize that the building is pandemic ready, or its health and safety, it is incorporated into it. I think that's sort of the indirect thing, if you will. It's the byproduct. It's not the thing. It's the thing that tells you that that you're doing the thing well. Net zero. We're spending a lot of time thinking about net zero. What does it mean? How do you achieve it? I think that a lot of cities are focused on this for new construction, and I think that's really great. But the reality in most countries around the world, in most cities around the world, the buildings that they're going to have 20 years from now already exist. And so we need to spend a little bit, I don't want to say we spend less time on thinking about new construction net zero, but we have to think an awful lot about how we get existing building stock to be net zero, either net zero ready, which is a concept, basically meaning the efficiency is really high, but for the renewables, it's ready to be net zero. But also, I think there's a lot of people that will associate and correlate the idea of net zero, if done properly, with health and safety. I think, no one's going to say this building is net zero, but it's got terrible air, or it's really bad, I don't want to be in it. They're going to naturally associate net zero with a lot of other things, including health and safety or pandemic. So I would say, net zero is sort of the top of this, because I think it's presumed intellectually to incorporate all these other things. It's going to be have green building certification by its nature. It's going to be pandemic ready by its nature and design. It's going to be incorporating health and safety as part of that. And I think that's where we have to sort of get to. We have to basically get to a point where our built environment is not detracting from our lives. It is not detracting from the experience we have as humans. And it incorporates and thinks about how we as humans relate to other stakeholders, whether it's the landscaping, whether it's the animals, the biophilia. It is arguably the highest level of sort of intellectual thinking and promotion of ideas.
Fantastic, Brett. That was really deep insight. Really appreciative of this. So you're saying that net zero is like the overarching, and then a pandemic-ready building, and health and safety or well-being, and finally a badge for a green building certification. Brett, we've come to the end of our session. I'd like to hear if you have any parting words or advice which you would like to give, especially being familiar with the business culture around these parts of the world, having been in Kuala Lumpur for a while yourself. What parting words of advice would you have for the audience?
I think, BK, that the most important thing is to recognize that at the most basic level, the tools we need to address climate and the environment, but also profitability of the built environment, we already have them. The question is whether or not we have both the strength to promote them, the strength to try to convince and, go with conviction to get other people to come along. The capital markets, they want to do this. The capital markets are not pushing against us. They're not fighting with us. They're saying, and again, I'll go back to the three words that you liked from before. You got to turn the ideas into projects. The capital markets are fundamentally awash with capital, but they finance a project, and you need to put it together. But we know what to do. The question is just simply, are we ready to do it? It will, in the short term, it will involve some sacrifice. Long term, we'll be creating an environment for ourselves which is simply better than what we have already today. Are we willing to do that? Are we willing to do the hard work that goes into that? And this is, not just an East versus West. It's not just a rich versus poor. It is not a white versus black and brown. It is really the idea that, we have to look at the world and recognize every one of us is just a small part of a much larger ecosystem. And we need to have all parts of the ecosystem working in order to have balance and harmony in our lives.
Brett, the organizers of IGEM 2020, Malaysian Green Tech Corp and Malaysia Green Building Council, we just thank you from our bottom of our hearts for taking your time off. It's almost past 10 o'clock at night in Washington. We really appreciate your effort, and we thank you, and we hope to hear from you again if we have another opportunity really soon. Thank you very much, Brett.
Okay, thank you very much. It was my pleasure.
Thank you. Ladies and gentlemen, with that, we come to an end of our session. Malaysia Green Building Council welcomes you to visit our website, and we are a sponsorship and membership-based organization, but we would be happy for you to join us and to fight this cause with us. With that, I hand it back to the control room. Thank you very much all, and we'll see you very, very soon. I leave you with the three precious words of Mr. Brad Doxer: ideas, green ideas into projects. Thank you.
Thank you.